Do you always feel that investing is like a war of information asymmetry? Professional institutions on Wall Street have strong research teams, complex analytical models, and can even obtain information one step ahead of us. We retail investors are like soldiers armed with broadswords and spears, going up against others, expert cannons. What chance do we have of winning? This thought of, I definitely can't outplay them, makes many people either shrink back from investing or blindly follow so-called insider information and expert recommendations, often resulting in heavy losses. However, the classic book we are going to delve into today, A Random Walk Down Wall Street, which has an 8.8 rating on Dubbin, will completely overturn your perception. With irrefutable data, it proves that precisely because thousands of professionals are working hard to analyze and trade, the market has become extremely efficient, and almost all known information is instantly reflected in stock prices. This means that those so-called expert advantages do not actually exist, and they too cannot consistently outperform the market. In the following time, we will see why the predictions of those million-dollar star analysts are often wildly wrong. This video will reveal a fair strategy that allows all ordinary investors to stand on the same starting line as professional institutions, making you understand that you are fully capable of building an impregnable fortress for your wealth. So when the book tells us that the secret of Wall Street is that there is no secret, we can't help but ask, what are those analysts and fund managers with million-dollar salaries busy doing all day? If their predictions and analyses are unreliable, what are they fiercely arguing about in the office every day? To figure out this problem, we must first understand that in the world of investing, there have always been two major schools. Their philosophies are incompatible, and each confrontation between them stirs up the entire market. And as ordinary investors, whether you realize it or not, every time you buy or sell, you are unknowingly casting a vote for the school you believe in. The first school can be called value detectives, and the book gives their theory a very solid name, firm foundation theory. These investors are like Sherlock Holmes in the financial world. They firmly believe that every company, whether it's a stock or a property, has an inherent, true value, just like a building has an unshakable foundation. Their job is to conduct meticulous analysis, like detectives, to find out what this intrinsic value is from clues in the company's financial statements, profitability, industry prospects, and other on-site details. Once this value is found, things become simple. When the market price falls below this firm foundation due to panic or other reasons, they buy decisively. Conversely, when the market price is hyped to the sky, far higher than this intrinsic value, they sell without hesitation. In their view, investing is such a plain, unglamorous, and even boring thing. It's nothing more than waiting for the market to make a mistake, then calmly picking up those mispriced treasures. The most famous practitioner of this theory is the Oracle of Omaha. We are all familiar with Warren Buffett. He and his teacher, Benjamin Graham, the master of the firm foundation theory, have practiced this philosophy throughout their lives. They tell you not to care about Mr. Market's mood today, but to care about how much the company you're buying is really worth. Does this sound particularly reasonable, like you found the right path to investing? But wait, this theory has a fatal flaw, an almost insurmountable Achilles heel. That so-called intrinsic value is not anchored in the present, but in the future. To calculate it, you have to predict how much profit the company will generate in the future and how much dividends it will distribute to shareholders. Predicting the future is something even God may not be sure about. So you see, the term firm foundation sounds reliable, but its underlying basis is built on predictions of the illusory future, and this foundation may not be as solid as it sounds. This leads to the second school, who are completely different from the value detectives. We can call them psychological masters, and the book gives their theory a very vivid name, Castle in their theory. Represented by the great economist Keynes, these people think that the value detectives are doing thankless and foolish things. Keynes himself was a top investment expert, It is said that he spent only half an hour every morning making investments in bed in his pajamas and easily earned tens of millions for himself and King's College, Cambridge, where he was affiliated. How did he do it? His core idea is figuring out how much a company is really worth in the market is both difficult and useless. What's really useful is figuring out what ordinary investors are thinking and predicting what they will do next. He believed that the essence of investing is not to evaluate value, but to analyze public psychology. Successful investors need to estimate which stocks are most likely to be built into a castle in the air by public hopes, then buy in advance before the public flocks in to gain an advantage. To illustrate this point, Keynes made a brilliant analogy. He said that stock investing is like participating in a beauty contest in British newspapers at that time. The rules of the contest were: the newspaper published 100 photos of beautiful women, and participants had to choose the 6 most beautiful faces. The one whose choices were closest to the average choices of all participants would win. Now, think about it. How would you win? Would you choose the 6 you truly think are the most beautiful? Of course not. The smart approach is to guess which ones others will like. But the problem is that others are thinking the same way. So the highest level strategy is to predict what the general opinion that everyone thinks others will form. You see, this has become a layered psychological game. You're not choosing beautiful women, but people's minds. That's the essence of the castle in their theory. In this world, something is valuable not because it is really useful or can generate much return, but simply because you believe that there will be a bigger fool willing to buy it from you at a higher price next. So this theory is also unkindly called the greater fool theory. As long as fools keep emerging, this game can go on forever. On one side are value detectives like Buffett, calculating value down to the last cent with a magnifying glass. On the other side are psychological masters like Keynes, who perceive human nature and try to get ahead before the crowd's carnival. So the question is, as ordinary investors, who should we listen to? Should we trust cold numbers or follow the passion of people's hearts? What's more troubling is why, no matter which school we follow, we still seem to be unable to escape the fate of losses. To answer this question, we must first look into the dust of history at several spectacular yet tragic financial dramas co-directed by these two theories. So when on one side are value detectives trying to calculate absolute value, and on the other side are psychological masters trying to guess public psychology, who should we believe? The answer may surprise you. When the market is truly in a frenzy, you can't trust anyone. Because at that time, both rational calculations and psychological games will become vulnerable. To understand this, we don't need complex theories. We just need to step into a time machine and witness several epic mouse frenzies written into the book by the author.
You might think that investment failures are because we are not smart or professional enough, but after reading these stories, you will understand that sometimes even the smartest minds in human history cannot resist mass hysteria. Our first stop is the Netherlands over 300 years ago, to witness a bubble triggered by a flower, the tulip bulb mania. In the early 17th century, tulips were a popular but expensive new item in Dutch gardens. What triggered this madness was a virus that infected tulips, causing colorful stripes to appear on the petals. The Dutch were obsessed with this because the more bizarre the bulb, the greater its value.
Soon, things started to go wrong. People were no longer buying tulips to decorate their gardens, but out of a simple belief: it would be more expensive tomorrow. Prices began to soar, and the more expensive the bulbs, the more people thought it was a wise investment. Soon the entire Netherlands was swept up in the frenzy. The book describes it this way: aristocrats, citizens, farmers, sailors, valets, maids, even chimney sweeps and elderly seamstresses joined the carnival. Everyone imagined that the passion for tulips would last forever. To participate in this game, people began to sell their possessions, land, jewelry, furniture, to trade for a small bulb, because they believed this bulb would make them richer. At that time, a financial instrument called call option emerged, which is essentially what we refer to today as a call option. It allowed people to leverage huge bets with very little principal, which was like adding fuel to the fire, making the bubble inflate even larger. The book tells a truly laughable true story. A sailor brought good news to a wealthy merchant, who then treated him to a hearty breakfast. The sailor saw something that looked like an onion on the merchant's counter, so he picked it up and ate it with his flying fish. Little did he know that this onion was a rare tulip bulb named Semper Augustus, whose value was enough to feed an entire ship's crew for a whole year. What happened next? The sailor was prosecuted for felony by the enraged merchant over this appetizer and spent several months in prison. You see, when the market is in a frenzy, the value of a tulip bulb has nothing to do with what it actually is. It is no longer a plant. It becomes a pure speculative symbol, a brick in a castle in the air. And the outcome? Like all bubbles, when prices rose so high that even the most optimistic people began to hesitate, some started selling. Panic soon spread like a plague, and prices collapsed instantly. The bulbs that people had regarded as treasures the day before became cheaper than ordinary onions overnight, and countless people's wealth vanished into thin air. You might say tulips are too far in the past. Then let's take the time machine to 18th century Britain and look at another famous bubble, the South Sea Bubble. At that time, the British economy was booming and people had a lot of savings, but no good investment channels. Just then, a company called the South Sea Company emerged. It obtained a monopoly on trade with South America, and the public immediately believed there were huge wealth opportunities here. So the company's stock price began to skyrocket. This mania gave birth to countless bizarre entrepreneurial projects. Someone set up a company to extract silver from lead, someone to extract sunlight from cucumbers, and even someone to build ships to fend off pirates. The most classic and revealing example mentioned in the book is a company whose prospectus stated, "The company is to engage in a highly advantageous business, but no one knows what it is." You heard that right. Even what it was going to do was unknown. Yet, within less than 5 hours of opening at 9 a.m., this prospectus attracted 1,000 investors to put their money in. The anonymous promoter then took the money, closed up shop, and vanished without a trace. At this point, you might wonder, were investors back then really that foolish? No, they weren't. The book points out sharply that they weren't stupid, they just thought they were smarter. They believed in the greater fool theory we mentioned earlier, thinking there would always be someone more foolish than themselves willing to buy at a higher price. They expected to sell quickly after the stock started trading to make a profit. What was the result? Even Isaac Newton, the greatest scientist of his time, suffered heavy losses in this bubble. He left a famous quote, "I can calculate the motions of the heavenly bodies, but not the madness of people." When the bubble burst, everything returned to dust. By now, some might think that tulips and the South Sea Company are after all antiques from hundreds of years ago. We modern people have the internet and more advanced financial tools, so we wouldn't make such low-level mistakes, right? Don't jump to conclusions. Let's set the time machine to the early 21st century, not so long ago, to the dot-com bubble. This bubble, in terms of scale and the extent of wealth destruction, far surpassed its predecessors. When it burst, approximately $8 trillion in market value evaporated worldwide, which was equivalent to the annual economic output of several countries at that time, such as Germany, France, the United Kingdom, and Italy. The situation back then was eerily similar to that of hundreds of years prior. On one hand, the internet represented a disruptive new technology. On the other hand, it offered brand new business opportunities, making it the perfect breeding ground for a bubble. Thus, history repeated itself. People no longer cared whether a company was profitable. A new valuation standard was invented called eyeballs, yes, the number of website visits. A company, even if it had no profits at all, could have its market value skyrocket as long as it could attract enough eyeballs. Many companies, even if their business had nothing to do with the internet, changed their names to end with .com just to boost their stock prices. What's the essential difference between this and that great unknown business back then? This carnival finally peaked in 2000, then collapsed like all historical bubbles. Countless promising star companies saw their stock prices drop by over 90%. Many went bankrupt and disappeared, and investors who rushed in at the peak were deeply trapped with heavy losses. You see, from a flower to an illusory trade certificate, then to a website's click count, hundreds of years have passed, and the objects of speculation have changed, but the underlying logic remains the same. That is, when the castle in the air theory dominates, the market is driven by public psychology, and prices become completely decoupled from intrinsic value. In such moments, rational analysis seems feeble, because you can't convince a fanatical group with value. Just as you can't wake someone who is pretending to sleep. So the question arises, we've seen that ordinary people can fall into madness, but what about the so-called experts, the professional fund managers, the analysts with complex models? They should be sober, right? They should be able to identify these bubbles and protect us ordinary investors, right? The truth might disappoint you. In many cases, these experts are not the firefighters coming to put out the fire. Instead, they are the ones carrying buckets of gasoline to pour on the flames. To understand why, we must dissect their two most prized secret weapons: technical analysis and fundamental analysis. In this part, let's first dissect the expert's first weapon, a seemingly profound and mysterious alchemy filled with cryptic charts and jargon, technical analysis. You must have seen its red and green candlestick charts, fluctuating curves, and various impressive terms like golden cross, death cross, head and shoulders, and W bottom. Simply put, technical analysis is reading the charts. Those who believe in it are called chartists. They have a core belief: all information about a company, whether good or bad, is already automatically reflected in its past prices and trading volumes. Therefore, you don't need to know what the company does, how profitable it is, or what its future prospects are. In their eyes, this fundamental information is, at best, useless, and at worst, even interferes with your judgment. A true chartist only needs one chart. The book gives an extreme example. John McGee, an early master of charting, even sealed the windows of his office with wooden planks to prevent external interference while analyzing charts. He locked himself in a dark room, isolated from the world, because he believed the charts held all the secrets of the future. What exactly do? They believe that stock price movements, like the physical world, have trends. A stock that is rising tends to keep rising, and one that is falling tends to keep falling. So their task is to find signals of trend formation in these charts. For example, they will draw an upward channel. When the stock price rises steadily within this channel, they consider it a buy signal. When the stock price struggles to rise, pulling back after several attempts to hit new highs, forming a head and shoulders pattern similar to the human body, they become extremely vigilant. Once the stock price breaks below the neckline connecting the two lows, they immediately issue a sell signal and exit without hesitation, believing a prolonged decline is most likely to follow. Does this sound cool? Like a martial arts master who can predict all subsequent moves from the opponent's every gesture. This method has attracted countless followers because it gives people a sense of control, an illusion of being able to predict the future. However, the author of this book, as a rigorous economist, launched the most fierce attack on this kind of fortune-telling through charts in stock analysis. The weapon used to shatter this illusion is surprisingly simple: the random walk theory. What is a random walk? The book gives a vivid analogy. Imagine a drunkard staggering around an open field. Do you know where he will step next? No, He might go forward or backward, left or right. The direction of his last step has no bearing on where he will go next. The author and academic researchers have found that short-term fluctuations in stock prices are as unpredictable as the drunkard's steps. The market reacts extremely quickly to information, so any predictable pattern, once it emerges, is quickly exploited and eliminated by arbitrageurs. Simply put, the stock market has a very poor memory. It doesn't remember how it moved yesterday. So don't expect to find a map to the future from its past footprints. At this point, chartists will surely jump up to object. Nonsense. I clearly see distinct patterns and trends in the charts. Wait, this is precisely the most fascinating part of the theory. To prove this, the author conducted an experiment at the university. He asked his students to construct a virtual stock price chart with a simple rule. The starting price was $50, and each day's closing price was determined by flipping a coin. Heads, the stock price rose by 50 cents. Tails, it fell by 50 cents. This is a completely random process, right? The result of each coin flip has nothing to do with the previous one. But when the students plotted the results of these 100 coin flips into a chart, a miracle happened. This chart, created by coin flips, looked no different from a real stock candlestick chart. It had obvious upward trends, downward cycles, and even various classic patterns that chartists regard as sacred, such as the head and shoulders top. The book also tells a more interesting story. The author showed such a randomly generated chart to a friend who was a firm believer in technical analysis. Upon seeing the chart, the friend was overjoyed and exclaimed, "Which company is this? This pattern is so classic. We must buy it immediately. It's definitely going to soar next week." You can imagine the look on his friend's face when the author told him that the chart was created by flipping a coin. This simple experiment is like a sharp knife, directly piercing the core balloon of technical analysis. The so-called rules you painstakingly find in the charts are likely just coincidences that are bound to occur in random events. Why are we so easily deceived? Because the human brain is inherently averse to randomness, we always want to find rules and patterns in everything. The book cites an example from the basketball court called the hot hand phenomenon. When a player makes several consecutive shots, we all feel that he has a hot hand and is more likely to make the next shot. But psychologists, after studying massive amounts of game data, found that the so-called hot hand phenomenon does not exist at all. The probability of a player making a shot this time is independent of whether he made the previous shot. We feel this way because our brains are better at remembering consecutive events and ignoring random, interleaved situations. It's the same in the stock market. When a stock rises for 3 consecutive days, our brains automatically label it with an upward trend and infer that it will continue to rise tomorrow. But in reality, this is no different from flipping 3 consecutive heads. It has no predictive power for the next result. So what's the conclusion? Academia has conducted rigorous computer tests on various technical trading strategies, such as Dow theory and relative strength systems, and the results are surprisingly consistent. After deducting transaction costs, no technical analysis method can stably outperform the simplest, dumbest buy and hold strategy in the long run. Technical analysis is like astrology, wearing the cloak of science, but with an unprovable belief at its core. A major reason it remains enduring on Wall Street is that it encourages frequent trading, which brings a steady stream of commission income to brokerage firms. Well, since chart reading fortune-telling doesn't work, what about the expert's other weapon? How about that seemingly extremely scientific and rational weapon, fundamental analysis? They don't study illusory charts, but delve into a company's financial reports, profits, assets, and calculate its intrinsic value. This must be reliable, right? Don't rush to judgment. When we put this weapon under the spotlight for a closer examination, you'll find that the truth behind it may be even more shocking than the failure of technical analysis. In this part, let's take a look at Wall Street's second, and supposedly most orthodox and scientific, weapon, fundamental analysis. Fundamental analysts are the value detectives we mentioned earlier. They study financial reports, analyze profits, evaluate management, and try to find a company's intrinsic value. This sounds like the true path of investing, a perfect combination of science and rationality. So, if we ordinary investors master this method, can we become stock gurus? Unfortunately, what the book is about to tell us may be a fact that overturns your perception even more. This seemingly extremely solid weapon is actually full of cracks. The author uses a wealth of research and data to reveal 3 fatal flaws of fundamental analysis in reality. The first fatal flaw is that its foundation, predicting the future, is almost an impossible task. The core of fundamental analysis is to predict a company's future profit growth, but the reality is that even Wall Street's top analysts have a disastrous track record in their predictions. The book cites a large-scale, multi-year study in which scholars compared the profit forecasts of thousands of companies by major Wall Street institutions with the company's actual subsequent performance. What was the result? The average annual prediction error rate of analysts was as high as 31.3%. Just think about what that means. It's not much more accurate than your random dart throw. You might say that's because some industries, like the high-tech industry, change too quickly and are hard to predict. Then let's look at the most stable and boring utility industry, such as power companies. They should be easier to predict, right? As a result, analysts' predictions for these companies are also wildly wrong. More disheartening is the finding that a company's past profit growth record is almost useless for predicting its future growth. Academia has given this phenomenon a name: growth chaos. In other words, a star company with high growth last year may stagnate next year. There is no such thing as a stable growth pattern. You see, if even the most basic goal, predicting profits, cannot be achieved, how reliable can all the value estimates based on this be? It's like trying to build a magnificent building with your foundation on quicksand. The second fatal flaw is more hidden and dangerous. The numbers you use for analysis may themselves be false. A company's financial statements are like a bikini. The parts it reveals are certainly eye-catching, but the parts it deliberately conceals are crucial. Driven by interests, many companies exploit loopholes in accounting standards to engage in so-called creative accounting, which is essentially legal fraud, dressing up mediocre performance to make it look brilliant. The book tells several classic cases, such as the once famous Sunbeam Corporation. Its CEO, nicknamed Chainsaw Al, even persuaded retailers to purchase barbecue grills, which are only used in summer, during the cold winter months, a slow season, just to make the profit figures look good. How did he do it? He promised that the retailers wouldn't have to pay for the goods now, and they could even keep the goods stored in Sunbeam's warehouses. You see, the goods didn't move, no money was paid, but sales revenue and profits were created just like that. A more advanced trick is the so-called pro forma earnings. Many companies, especially high-tech companies during the dot-com bubble, would conveniently exclude some non-recurring expenses they deemed when announcing earnings. As a result, a company that actually incurred losses could instantly appear profitable under the packaging of pro forma earnings. The book even quotes a Wall Street quip that such earnings should be called earnings before I tricked those stupid auditors. Just imagine, when a value detective uses such a carefully beautified map to search for treasures, what he's likely to find is nothing but one trap after another. The third and most fatal flaw lies in human nature. An analyst's position often determines his perspective. Traditionally, we think analysts work for us investors, but the reality is that the big money-making business on Wall Street is not the transaction commissions from retail investors, but investment banking businesses that help companies go public, raise funds, and merge. One deal can bring in hundreds of millions of dollars in commissions. Thus, the role of analysts becomes very delicate. Their salaries and bonuses largely depend on their ability to help the company's investment banking department secure business. How do you secure business? The simplest way is to rate the stocks of your potential client companies as strong buy. The book explains that during the height of the dot-com bubble, the ratio of buy-to-sell recommendations from Wall Street analysts reached an astonishing 100 to 1. This meant that in their eyes, there were almost no stocks worth selling in the market, and behind this was a blatant conflict of interest. The New York State Attorney General once seized internal emails from Merrill Lynch, which revealed that the internet stocks publicly and strongly recommended for purchase by star analyst Henry Blodgett on TV were privately referred to by him as junk and pieces of crap. They publicly advised you to buy while privately knowing it was a pitfall. Why? Because these companies were their investment banking clients, their financial backers. Therefore, the research reports you see are not so much objective investment analyses as they are carefully packaged commercial promotion articles. Well, let's summarize here. Fundamental analysis, which is regarded as a guiding principle, has vague predictions, questionable data, and impure motives. When these three fatal flaws come together, can you still count on it to lead you to financial freedom? This leads to a conclusion that unsettles the entire Wall Street, a view put forward by academia that can be called the theory of relativity in investment theory, the efficient market hypothesis. The core idea of this hypothesis is that precisely because there are countless investors like you and me, as well as more professional ones, trying to make money by analyzing various information every day, almost all useful information is instantly digested by the market and reflected in stock prices. In other words, when you see good news in the news or discover an undervalued company in a research report, the price is likely no longer cheap. The invisible hand of the market has already discounted all known positives and negatives into the current stock price in advance. This explains why most actively managed funds run by top experts fail to outperform a simple, unmanaged market index in the long run. Even Benjamin Graham, the originator of fundamental analysis, admitted shortly before his death that in this era of highly developed information, the sophisticated analytical methods he relied on to make a name for himself in his youth might no longer be effective. So you see, after going around in a big circle and dissecting the experts' two secret weapons, we end up with a frustrating yet fair reality. In this market, there seems to be no magic formula that can consistently outperform everyone. Does that mean we are completely hopeless? That we can only resign ourselves to fate? Don't worry, it's precisely after we recognize this reality that true investment wisdom begins to emerge. Because we will realize that our greatest enemy may never be the so-called experts or institutions, but the person in the mirror. To understand this, we must enter a newer and more interesting field, behavioral finance. In the previous part, the book tells us a deeper secret. In the game of investing, our greatest enemy is never the market nor the so-called experts, but ourselves, our brains full of various biases and irrational impulses. To understand this, we must learn about an extremely fascinating field that gradually emerged in the early 21st century, called behavioral finance. In the past, economists lived in an ideal world, assuming that each of us is a rational economic man, making decisions calmly and objectively, with the sole goal of maximizing our wealth. But two psychologists, Daniel Kahneman and Amos Tversky, stood up and said, "Wait a minute, have you economists ever dealt with a real human being?" Through a series of ingenious experiments, they proved that humans are full of various systematic biases when making decisions, and our behaviors are far from being completely rational. This discovery was revolutionary at the time, and Kahneman even won the Nobel Prize in economics for it. Yes, a psychologist took home the highest award in economics for telling economists, "Your understanding of human nature is wrong." So, what are the system vulnerabilities in our brains that can lead us to make big mistakes in investing? The book summarizes several of the most common ones. The first and most prevalent vulnerability is called overconfidence. Here's a simple question for you. Compared to all other drivers on the road, do you think your driving skills are above average or below average? Psychologists have conducted countless experiments with this question on different groups of people, and the result is always that more than 80% of people firmly believe their driving skills are above average. You see, in a normally distributed world, this is mathematically impossible. It's like the town of Lake Wobegon mentioned in the book, where all the women are strong, all the men are good-looking, and all the children are above average. This illusion of "I'm better than average" is particularly pronounced in the field of investing. Each of us thinks we have the potential to find dark horse stocks, that we can buy low and sell high and seize the market rhythm. This overconfidence directly leads to one of the most common money-losing behaviors, overtrading. Behavioral finance researchers studied tens of thousands of real investors' trading accounts and found an iron law. The more frequently investors trade, the worse their long-term returns are. Male investors, in particular, tend to show stronger overconfidence than females, trade much more frequently, and as a result, their investment performance is correspondingly worse. We always attribute accidental success to our own abilities, while blaming failure on bad luck or external circumstances. If you happen to buy a stock that doubled in value last year, you'll think you're a stock god, then start trading frequently, trying to replicate that success. But this overconfident trading does nothing for your wealth growth except contribute a lot of commissions to brokers and increase your tax burden. The second vulnerability is more hidden. It's called herd behavior, or what we often refer to as blindly following the crowd. We are social animals, born with a desire to fit into groups and fear of isolation. This instinct can become a fatal trap in investing. Social psychologist Solomon Asch conducted a classic experiment where he showed a group of people two cards, one with a standard line segment and the other with 3 line segments of different lengths. The question was simple: which line segment is the same length as the standard one? The answer was obvious to the naked eye, but the clever part of the experiment was that, except for one real subject, everyone else in the group was a plant, and these plants would deliberately give the same wrong answer. The result? When the real subject heard everyone giving a different answer from their own, there was a more than 1/3 chance that they would abandon the fact they saw with their own eyes and choose to submit to the group's wrong answer. The latest brain science research even found that in such cases, the sensory areas of our brains really do change, meaning that others' opinions can actually alter the facts we perceive. Now, think about the stock market again. When a concept is hyped up and your friends, colleagues, and relatives are all excitedly talking about how much money they made on a certain stock, how does that feel? Economic historian Charles Kindleberger once said a famous quote, "There is nothing so disturbing to one's well-being and judgment as to see a friend get rich." Thus, herd behavior begins. We buy a stock not because we've researched it and believe in its value, but simply because it's rising and others are buying it. And when the market falls and panic spreads, we rush to sell because we see others selling. Data clearly paints this tragic picture. The amount of money ordinary investors put into the stock market always peaks at the most feverish top of the market, while the amount of money they redeem, i.e., sell at a loss, always peaks at the most panicked bottom of the market. As a group, we seem to be masters of the art of buying high and selling low. The third vulnerability may hit closest to home for each of us. It's called loss aversion. Here's another question. Let's play a coin flipping game. If it's heads, you win 1,000 yuan. If it's tails, you lose 1,000 yuan. It's an absolutely fair bet. Would you be willing to play? I guess you'd probably refuse. Why? Research by Kahneman and Tversky provides the answer. the pain we feel from losing 1,000 yuan is approximately 2.5 times the pleasure we get from winning 1,000 yuan. We are inherently extremely averse to losses, and this psychology leads to a very irrational behavior common among investors, called the disposition effect. What does this mean? It means we tend to sell stocks that are making money too early because we want to lock in the paper profits and enjoy the pride of victory. At the same time, we cling tightly to stocks that are losing money, reluctant to sell them. Because once we sell, those paper losses become real losses, and we are desperate to avoid the regret and pain of admitting our investment failure. Think about your own account. Aren't there a few problem stocks that you've long known have a bleak future, but you just can't bring yourself to sell, always fantasizing that one day you'll get your money back? From a rational perspective, this behavior is utterly foolish. Because when you sell profitable stocks, you immediately face the issue of paying capital gains taxes, whereas selling losing stocks can actually give you tax deductions. Moreover, paper losses are just as much real losses as actual ones. Deciding not to sell a losing stock is equivalent to deciding to buy that stock again at the current market price. So you see, overconfidence makes us trade too frequently, herd behavior makes us buy high and sell low, and loss aversion makes us fail to hold on to profits while clinging to losses. These systemic flaws deep in our brains are the real culprits behind our investment failures. We always thought investing was a game of IQ and information, but behavioral finance tells us it's more of a discipline of emotional intelligence and self-control. Our greatest enemy is not the unpredictable market, but our own hearts that swing between greed and fear. So the question arises, since experts are unreliable and our own brains are unreliable, are we really hopeless? Is hiding money under the bed the only way to feel secure? Of course not. Precisely because we recognize these traps, we can learn how to avoid them. And modern finance has provided us with a new investment framework that can counter our natural instincts. This framework doesn't require you to be a genius who can predict the future, nor does it require you to become an emotionless robot. It only requires you to understand one core concept, a great idea that also won the Nobel Prize, and this is what we will explore in the next section, Modern Portfolio Theory. In this section, we'll look at this Nobel Prize-winning great idea that revolutionized traditional investment concepts, which the book calls modern portfolio theory. The name sounds a bit academic, but its core idea is so simple that it's like a layer of window paper, easily pierced. It completely changed the goal of the investment game. In the past, almost all investors, from Wall Street elites to street grandfathers, were asking the same question: how can I pick that stock that will rise tenfold? Everyone wanted to be a hero, to find that golden needle in the haystack. But Harry Markowitz, the founder of modern portfolio theory, asked a completely different and wiser question: how can I build an impenetrable portfolio? You see, the focus has shifted. The emphasis is no longer on picking individual heroes, but on building a strong team. This shift in thinking is the key step for us ordinary investors to move from losses to profits. And the core secret of building this team is two words: diversification. I know you're tired of hearing, don't put all your eggs in one basket, but you may never have truly understood how magical the power of diversification can be. The book uses a brilliant example to make you understand instantly. Imagine we live on an isolated island where the economy is supported by two companies. The first is a resort with a beachfront and a golf course. The second is an umbrella factory. The fortunes of these two companies depend entirely on the weather. If the year is sunny and pleasant, the resort's business will boom, bringing you a 50% return. But at the same time, the umbrella factory will be deserted, causing you a 25% loss. Conversely, if the year is rainy, the resort will be empty, losing you 25%, while the umbrella factory's business will be booming, earning you 50%. Now you have 20,000 yuan in hand. how do you plan to invest it? If you're a gambler, you might put all your money into the resort and pray for sunshine every day, or all into the umbrella factory and pray for rain every day. Either way, your heart will rise and fall with the weather forecast, and your wealth will fluctuate like a roller coaster. That's risk. But if you're a smart investor, you'll split the 20,000 yuan into two, investing 10,000 in the resort and 10,000 in the umbrella factory. Let's see what magical things happen. If it's sunny all year, your 10,000 in the resort earns 5,000, and your 10,000 in the umbrella factory loses 2,500. Your final gain is 2,500 yuan, which is exactly 12.5% of your total investment of 20,000 yuan. What if it's rainy all year? Your 10,000 in the umbrella factory earns 5,000, and your 10,000 in the resort loses 2,500. Your final gain is still 2,500 yuan, which is still 12.5% of your total investment. You see, a miracle happens. The resort and the umbrella factory are both highly risky investments on their own, their fortunes entirely in the hands of unpredictable weather. But when you combine them, the risk vanishes into thin air. Whether it's sunny or rainy, you steadily get a 12.5% annual return. The resort's profits perfectly offset the umbrella factory's losses. That's the magic of diversification. Of course, the real world is much more complex than this island. Most companies' fortunes are tied to the same weather of the broader economic environment. When the economy is good, everyone rises together. When there's a recession, everything falls. We can't eliminate all risks like we can on the island. But Markowitz's great contribution is that he proved with rigorous mathematics that as long as the assets you invest in don't rise and fall in perfect 100% synchronization, diversification will definitely reduce the risk of your overall portfolio to some extent. So the question is, how many stocks do we need to buy to get this diversification protection? The book provides a very intuitive chart. Studies show that when you start adding stocks of different companies to your portfolio, the risk of the entire portfolio drops rapidly. When you hold about 50 stocks, the non-systematic risk, caused by a single company's poor performance or scandals, is basically eliminated. What's left is only the unavoidable systematic risk faced by the entire market. So the first level of diversification is to hold a wide range of companies from different industries and types in your domestic market. But that's not all. This theory has undergone a major upgrade: global diversification. We must recognize that the world we live in is a closely connected global economy, and the economic cycles of different countries are not always synchronized. When the US economy is recovering, Europe may still be struggling. When developed markets are consolidating, emerging markets' economies may be growing rapidly. This provides us with a second and more powerful opportunity to reduce risk. Data in the book shows that if you gradually add international stocks to a portfolio that only holds US stocks, a wonderful phenomenon occurs. For a long time, the risk of your entire portfolio not only doesn't rise because you added some riskier overseas stocks, but actually falls. At the same time, your long-term average return may even increase. This lower risk, higher return sounds like a fantasy, but it's a real benefit of global diversification, something close to a free lunch in investment risk. So you see, the wisdom of investing now is completely opposite to our past understanding. It tells us that the focus of investing is not to predict which company will be the next Apple, but to build a sufficiently diversified Noah's Ark that can withstand all storms. Our goal is no longer to be the hero who can predict the future, but to be a humble architect who knows to respect the market. We no longer try to beat the market, but to use the market's laws to smartly manage risk. Okay, we understand the theory, diversification, building our Noah's Ark in global markets. But how to do it specifically? Do we really have to pick dozens or hundreds of companies around the world ourselves? That's too unrealistic for us ordinary people. Don't worry. The financial market has prepared an extremely simple, low-cost, and accessible powerful tool for us. It allows us to easily buy the world's haystack with just one sum of money. This is the ultimate destination of our walk down Wall Street, and the final answer this book will reveal to all ordinary investors. Before we start this section, it needs to be reminded that all the specific action plans we are about to discuss are entirely derived from the viewpoints and suggestions in the book A Random Walk Down Wall Street. Although this is an investment philosophy framework that has stood the test of half a century, it may not be suitable for the domestic market, nor can it replace your own independent thinking and judgment. All right, let's see how to specifically build this Noah's Ark-like investment portfolio. Do we really have to pick dozens or even hundreds of companies from around the world by ourselves? Of course not. This book points out an extremely simple shortcut for us, a great invention for ordinary investors, which is the index fund. The principle of this tool is as simple as one-click replication. It makes no predictions and does not attempt to pick out performing stocks. Its only task is to completely replicate a broad market index, such as the S&P 500 index, or a more comprehensive overall stock market index. It buys whatever is in the index in the same proportion as the index. When you buy an index fund, you instantly own shares in thousands of companies in the market, and you are buying the average performance of the entire market. You might think that pursuing the market average sounds too unambitious, but historical data tells us a cruel reality. It is precisely this average that, in the long run, has outperformed more than 2/3 of the expensive professional fund managers. Why is this the case? The reason is simple yet profound. Firstly, there is a huge cost advantage. Active funds charge high annual management fees because they need to pay high salaries to fund managers and research teams, while index funds have extremely low costs because they only passively replicate. In the long run of investing, costs are like the sandbags on your back. The heavier the sandbags, the slower you run. There is a profound saying in the book, in the fund industry, you get what you don't pay for. Secondly, there is tax efficiency. Frequent trading by active funds constantly generates taxable capital gains, which can seriously drag down your actual returns. However, the buy and hold strategy of index funds can help you legally delay or even avoid this part of taxes to the maximum extent. Therefore, index funds are the core and most effective building blocks for constructing a diversified investment portfolio found in this book. With building blocks, we still need a blueprint, which is another extremely important action framework proposed in the book, The Life Cycle Investment Guide. Its core idea is, your investment strategy must change with your life stage. A young person in their 20s and a retiree in their 60s have vastly different abilities to bear risks, and their investment portfolios must also be completely different. This guide depicts a lifelong wealth path for us. In your young stage, your greatest capital is time, and you have decades of working life to earn money. Therefore, the framework in the book suggests that during this period, your investment portfolio should be very aggressive, allocating a high proportion of assets to categories with high growth potential such as stocks, and you should look globally, boldly embracing international stocks, including those from emerging markets. As you enter middle age, family responsibilities increase and retirement gets closer. At this time, you need to gradually reduce risks. The framework in the book suggests that you should start to gradually reduce the proportion of stocks and increase the proportion of more stable assets such as high-grade bonds. Your goal is to continue pursuing growth while starting to protect the wealth you have accumulated. Finally, when you enter retirement, your investment portfolio will change from a money-making machine to a cash dispenser. Its primary task is to preserve value and provide stable cash flow. Therefore, safe assets such as bonds and cash will become the mainstay of your investment portfolio. However, to combat inflation, your portfolio still needs to retain a portion of stock assets to ensure that your purchasing power does not shrink over time. You see, this is a very clear and logical investment system. It simplifies complex investment decisions into 2 core steps. First, choosing what tools to use. Second, how to match these tools. This method is the broad road for ordinary people to achieve investment success. It does not require you to be a genius, only that you have rational planning and long-term discipline. Of course, this is a universal philosophical framework. The book provides very specific examples of asset allocation percentages and more detailed strategies for different life stages, like a clear map. If you are interested, you can read the original book to find the reference template that best suits your situation and adjust it according to your own risk tolerance.
Alright, we already have the core action plan, using index funds as building blocks and the life cycle guide as a blueprint. But is this the only answer? The author fully understands that investors have different personalities and preferences, so at the end of the book, he summarizes 3 different walking paces for us. You can choose the one that best suits you according to your situation.
The first, and the one most advocated by the author, is the effortless slow pace. The core of this path is what we have just discussed in detail, constructing your investment portfolio entirely with low-cost, broad-coverage index funds. You buy the entire market, then go on with your life, letting the long-term growth of the market work for you. This is a strategy of great wisdom appearing as foolishness. You give up the choice of trying to beat the market, thus avoiding high fees and unnecessary risks. Historical data has repeatedly proven that it is this seemingly mediocre average market return that ultimately surpasses most experts who try to pursue excellence. For the vast majority of ordinary investors, this is the simplest, most reliable, and most worry-free choice. The second pace is prepared for those friends who still love challenges and enjoy the fun of stock picking, called the hands-on slow pace. If you just can't give up the pleasure of personally joining the fray, this book does not completely deny you. But it strongly suggests that you should adopt a core satellite strategy. Firmly invest the majority of your core assets, which are related to your future, into index funds, and only use a small portion of non-essential satellite funds to enjoy the game of picking individual stocks. Even so, before you start, the book provides 4 golden rules that can greatly improve your chances of success and reduce risks. First, only buy companies with sustained above-average profits for many years. Second, never pay too high a price for a stock, and be wary of popular stocks with sky-high price-earnings ratios. Third, look for companies with both solid value and attractive stories that can inspire public imagination. Fourth, trade as little as possible. Firmly hold onto profitable stocks and decisively sell losing stocks to gain tax advantages. These 4 rules are your most important amulets on this adventurous path. The third pace is the using a substitute half pace. That is, you are not satisfied with index funds, nor do you have the time or confidence to pick stocks yourself. So you decide to hire a professional fund manager, that is, buy actively managed mutual funds. But we already know that it is almost impossible to pick out the future consistent winner from thousands of fund managers, and past performance is not a predictor of future success. So, if you insist on taking this path, are there any clues that can help you increase the probability of choosing the right one? Research in the book found that among all indicators, only 2 factors are relatively reliable for predicting a fund's future performance: extremely low management fees and extremely low turnover rates. Therefore, if you insist on looking for active funds, forget those fancy advertisements and past performance rankings, and focus your attention firmly on these 2 most basic indicators: cost and trading frequency. All right, there are 3 paths pointed out by the author for us: the effortless index followers, the hands-on adventurers, and the authorized substitute seekers. You see, the ultimate wisdom of investing may be this simple. It has nothing to do with complex models or mysterious predictions. It is about rational planning, strict discipline, control of costs, and most importantly, patience with time. It is hoped that this walk down Wall Street can help you see the road ahead clearly, get you a pair of comfortable and sturdy shoes, and let you walk more steadily and further on the road to wealth in the future. Thank you all for watching, and we'll see you in the next book.